Good morning and welcome everyone to the Moneycontrol live stream. You are watching another edition of Markets with Santo and CJ. Well, after the stellar comeback yesterday in the afternoon trade, it seems that we are all set to end the week on a very positive note. If you look at the Nifty futures on the Singapore exchange at this moment, they're indicating a gap up opening or more than 80 points of up move on the Nifty index today. But the critical question will remain is whether the index will be able to cross the 16,400 level resistance and confirm a pullback. Before it does that, it will be very crucial to see if the index goes above the 20-day moving average of about 16,322 points. If it does that, then that could, relay a lot of confidence towards the bull and could make the bears sweat a little.
Well, CJ, even if there is a pullback, I've been saying this and I maintain that even if there is a pullback, I think one should use that opportunity to book profits, get out of stocks where earning visibility is low. And
you sound like Christopher Wood, Santo.
Well, yes, I think that's the only sensible thing to do. I feel in this kind of a market, you're not seeing buying support coming in at higher levels. And apart from the fact that foreign funds have been relentless sellers now for months in a row, you're not seeing direct retail money also come at the same pace as they used to come earlier. Clearly, there is some bit of trepidation now that prices have fallen quite a bit. And repeatedly people point to the fact that stocks are 30-40% off the peaks, but so they may be cheap. But at the same time, let's not forget most of these stocks have also rallied 4 or 5 times from the pandemic lows. So people are sitting on profits right now, and they think that okay, probably how low can it go? But trust me, bear markets can get really bad.
Santo, excuse me. I feel that, probably, yes, it is no longer a market where, everything is going up simultaneously. And there was a point of time, if you remember in 2021, where you could just, close your eyes and pick and choose any stock in the 2000 stocks listed on the NSE and you will still make money, right?
Right.
This is definitely not that sort of a market. But I think that we are in a mid-cycle bull market wherein stock picking will become more and more important. You will see active management of funds, that is why you will probably end up seeing active mutual funds also outperform, some of the passive funds out there this year, because this market is all about the skill of stock picking. And good stock pickers will definitely find opportunities, especially those opportunities which had gone out of bounds in terms of valuation. A lot of those valuations have now compressed, whereas the earnings outlook has not deteriorated as much as the price correction might
CJ,
seem.
for once, I'll agree with you there clearly. And I think too much money had been flowing into passive funds to the point that everyone thought that this is like a no-brainer. All you have to do is just get into passive funds, and it's an assured kind of return. But I think that trend will also change. That said, let's now move into some of the stocks on our watch list today, starting with Adani Ports. In line fourth quarter numbers from the ports major. Now, I'm bullish on this stock, CJ. This is the #1 port operator in the country with almost a 25% share of all cargo movement, and most importantly, it's got a very diversified mix as far as the as far as cargo is concerned. Now, there are concerns about the company's huge, planned capex of about 23,000 crores, but also at the same time, it is really taking a bet with a longer term vision there. It is according to analysts tracking the stock, it's investing the money not in grade B or C warehouses, but grade A warehouses. And while there are concerns that given the global headwinds at this point, it may not make much sense, I think he's playing a longer term game out there. And it's also, the company is optimistic that it will see higher volumes in the coming year, mainly from import of coking coal and export of agri items.
Santo, I do not take, your view might have some, point of strength to it, but I feel that the weaker than expected earnings for the March quarter was a bit of a blow to the valuation, argument of Adani Ports. If you look at the 3-month performance of the stock, it has largely remained flat when there has been carnage across,
Isn't that a good thing? The stock has managed to hold ground in a volatile market.
The reason that was the case was because the earnings outlook for Adani Ports seemed so benign, right? It seemed so good. But the March quarter numbers and the outlook that the company has given, that has shown that even Adani Ports is not, out of the woods in terms of where the earnings are going to go. If you look at the volume guidance that they have given for FY23, about 350 to 360 million tons of cargo they expect to be handling in FY23, which is not really much higher than about 312 to 320 million tons of cargo they handled in FY22. If you look at also the capex, you talked about the capex. Now they are front loading a lot of that capex. The 23,000 crores in capex. They have already gone out and bought out some of the distressed ports out there. Yes, the capex is geared towards meeting their target of handling about 500 million tons of cargo in by FY25. But Kotak Equities believe that this sort of front ending of the capex could end up, lowering or lead to a lack of clarity on the returns that they could get on this capex. Remember, returns on the capital employed is a very important, metric that investors tend to lean on. And here, with the 23,000 crore capex happening so soon after spending thousands of crores on acquiring some of the recent ports like Krishnapatnam and Gangavaram, Kotak Equities feels that this is something that the company could have avoided. They could have probably streamlined the capex a bit more, and that would have given investors confidence in terms of returns that they can get out of the capital.
So, the promoters have increased their holding in this company by about 1.5% during the March quarter. I think that speaks volumes of the management's confidence in the business, I would say.
I don't know about the management confidence, but at this point of time, the market's confidence is clearly not there. Yesterday, the stock took beating, and I expect that weakness to continue at least for the coming in the near term.
We shall see, CJ.
That said, one stock where the weakness has been been a lot, but the earnings performance has been quite strong. It is Hindalco Industries. The company came out with a strong set of numbers for the March quarter, and that basically reasserts the point of view that the growth outlook or the earnings outlook for Hindalco still remains quite strong, despite the beating that the stock has taken over the past 2 to 3 months. If you look at what CLSA India had to say post the company's earnings, they believe that the near-term headwinds for the company are now clearly factored into the price of the stock, Santo, and therefore valuations have become attractive, and prices at this juncture do not reflect the overall longer-term outlook for the company. If you look at something else that CLSA also said is that the near-term headwinds in terms of domestic aluminium volume as well as domestic spot prices also coming down, they do not deter them from the view that the company will be achieving about $500 per ton of profitability in the coming years, and that is the major play. They also believe that Hindalco will not end up having huge amount of debt on its book, despite the $8 to $10 billion capex that it has promised. You have been raising concerns about how that capex will be funded, but CLSA believes that debt level will not rise. The company will continue on the the deleveraging process that it has been over the past 2 to 3 years. So this is one stock where valuations have corrected significantly and earnings outlook still remains strong. So I think it's very obvious where my view stands.
Well, CJ, I don't think metal is the space you should be in this market right now.
Why not?
The sentiment has clearly changed, and the kind of price rise that you saw in aluminium didn't sustain, it did come off. Now, I'll tell you what, CJ, you can clearly see some bit of pushback coming from the user industry, and if you see today's news reports also, many of the white good majors are cutting down on their output targets, which shows that clearly because of inflation, there is a problem, right? So demand is going to come. Besides, on the auto sector also, there are no clear signs of recovery. Things are getting better than what they were, but there also it's a very, very gradual recovery. When commodity prices go up, obviously there is a pushback, and we are clearly seeing it more in the aluminium sector as well. And lastly, I think this whole thing about the debt not being there on the books is the internal accruals is depending on how strong your sales are going to be, right? That's when you generate money. And if the demand remains weak, then that story will be under a bit of question.
Well, Santo, first of all, talking about the metal space, I think, as I mentioned earlier, this is going to be a stock pickers market. And even within the metal space, there are going to be individual stocks that will give you outperformance, whereas the broader view on the sector might be negative. You're talking about, demand. Yes, India demand story may have taken a hit because of the weak demand that is coming out from the consumer industry for aluminium. But let's not forget, a large chunk of Hindalco's earnings now are coming from Novelis Corporation, right? And LRS. So though globally, the demand environment has not suffered as much as people are fearing. Plus, you still have China, yet to come back out of the lockdown. And people, as somebody, yesterday said, the market is underestimating the sort of demand bump that China will give to commodities market. And I don't think that is being yet factored into the price of many of the metal stocks, leave alone Hindalco.
In April, aluminium was what China exported the most. So
that's okay.
That okay. Probably explains
but
why
it will
the
never go back to the levels that we used to see 5 to 7 years ago, which had depressed international prices for a very, very long time.
Lemon Tree Hotels, now CJ, one of my favorite themes, the opening up of the economy and the strong holiday seasons. Now, third quarter numbers, the fourth quarter numbers are likely to be a bit of a disappointment, but most likely the market may have already discounted that. If you look at how the share price has been moving, it's been discounted to a large extent. It's been quite steady even in a volatile market. I think one should look for trends from the third quarter numbers where it showed a very clear improvement in its revenue per available room. It almost kind of doubled, and because of COVID, you saw that again taking a hit in the fourth quarter. That is likely to reverse now in the April to June quarter. So I think this is one of the stocks that, apart from the top line stocks, which anyway are a good bet, this is in the second line space. Lemon Tree is something that one could look at.
Santo, I feel that, while the hotel story may be a good bet over the next 12 to 18 months, but at this point of time, the next few quarters, the outlook has become a little muddled because of the rise in prices that we are seeing across the economy. I feel that households probably might defer some of their plans because they would not want to, at this point of time, take any discretionary expenses
that could
hurt their wallet.
Where have all the Robin Hoods gone? I thought they were traveling all over the place.
That is what my next point was. The second point that I want to make is that in a quarter like March quarter, where for 3 months, all the reels that I saw on Instagram were all about how people were in Goa, they were in Pondicherry, they were in Port Blair. Okay, all of these they were in mountains. Even in a quarter like that, when the entire youth of this country was out there traveling in December quarter, in the March quarter, if the company could not perform well, I really doubt that they can perform well going ahead. I think there are better bets than Lemon Tree in the hotel space, probably one company specifically in the Tata Group. But if you cannot capitalize on a growth momentum like that, I do not know what they can do in
the numbers quarters. Are yet to come out, so I think we should still give
but it doesn't look very pretty. That said, one stock where things are probably a little iffy at this point of time, but the overall longer term outlook remains quite strong if you take into account the price correction that the stock has seen, is Zee Entertainment Enterprises. Well, we knew where the story was about 6 months ago, for a few months ago, for Zee with respect to the merger with Sony India. Now, the March quarter earnings came out and they were largely above expectations if you go by Edelweiss's estimates. And the only sad point was the advertisement sales were struggling, but Edelweiss believes that the merger will remain very will boost advertisement sales going ahead, and as and when ad sales revive, Zee will be the biggest beneficiary.
Well, before I counter that argument, CJ, the market has opened and a very upbeat start for the Nifty.
Very good start.
150 points up on the index. 16,318 is where the Nifty is right now. Nifty Bank is up about 1%, is up 318 points.
The second line stocks are actually doing much better at this point of time. The Nifty Mid Cap 100 Index.
Well, your Hindalco is up 4%.
Yes, exactly. I told you. Nifty Mid Cap 100 Index is up about 1%, and the Nifty Small Cap 100 Index is up about 1.2%. So it's the broader market which is leading this revival at this point of time. And let's not forget that this is the second day of buying after the late buying that we have seen yesterday. This should give bulls a lot of heart, but it remains to be seen whether the index itself will be able to cross the hurdle of 16,400. It is currently around 16,300, so the 20-day DMA has not yet been breached. So that will be very critical in the coming hours, whether we can go beyond that 20-day DMA, and that would trigger some stop losses for those who were holding short positions.
This is still a slow grinding lower market is what I feel, but well.
Anyway, you were going to counter me.
On Zee, well, I think the balance sheet is in a better shape now than what it was right now, and I take that point about ad sales and everything. My only limited point here is that probably because of technical factors, you could see the stock struggling for a while. when the merger story was quite hot sometime in September, October, you'd seen a huge build-up of positions there. A lot of people had gotten, if you look at the charts, huge volumes there. But since then, the stock has been struggling. So a lot of people who had bought into the merger story at that point in time are still stuck with the stock because it's been underperforming for a while now. It's not fallen sharply, but it has been pretty range bound. So when the stock begins to break out, I think so there could be a lot of fatigued selling coming into the stock, which could
I doubt, Santo, because this is you have still not seen the what the benefits of the merger will be for Zee. I mean, this could be a 3 to 5 year story in the media space, especially when we still have the IPL broadcasting auction yet to happen. And if Zee could end up winning that, then that could be a big turnaround for Zee and a big win for the merged entity, right? So there are few triggers out there for the stock, and given the recent correction, I think that would probably provide an entry point for a lot of people who missed out on the stock, given that the stock jumped almost 40-45% on the day of the announcement of the merger, and then subsequently it added a few more percentage points to that move, and since then it has corrected a fair bit, I believe, largely in line with what the market has seen over the past 3 to 4 months.
Well, the last stock on our watch list for this morning is Ipca Lab. Fourth quarter numbers reported the day before, pretty much in line with what market was expecting. The bright spot in the company's earnings were strong growth in its India business, and that is something that analysts are very positive on. Also, the management has guided for about 20 to 22% EBITDA margins in this quarter, which is also something that most analysts are buying into. They see an increase in operational expenses because the company is strengthening its field force. It's investing a lot of money there. Only natural, given that the domestic business is doing quite well. But analysts again see that as a long-term positive playing out over the next 3 to 5 years. Also remember, this is a vertically integrated pharma player, so it will gain from the opportunities in the API space as well. 2 of its plants have recently been commissioned, so you're going to see some upsides coming from those in the coming quarters.
Santo, I'm not really convinced by Ipca Lab. I mean, okay, the domestic business is doing well, but the domestic business is doing well for probably most of the pharma companies out there. So where is the outlier? The outlier in terms of growth for Ipca used to come from its Europe and the US business, right? Now, the European business is definitely under pressure because of the geopolitical crisis that we are seeing in Eastern Europe at this point of time, and overall demand environment also coming under pressure because of slowing growth and higher inflation. Apart from that, the decline in Q4 margins is definitely a point of concern. As you mentioned, operating expenses are going to go higher because of higher fuel costs, logistic expenses, traveling is coming back, and because they are adding to their field force, therefore those sort of sales expenses are also going to go up. So therefore margins will also remain under question in the coming quarters. Apart from that, if you look at ICICI Direct, they have also downgraded their rating on the stock to hold from buy earlier, and they believe that the export story is now struggling, and therefore growth itself will struggle for the company, because the domestic business can only hold fort for the company, but a good amount of growth, double-digit top-line growth will only happen if the Europe and the US business revives, and that is unlikely to happen.
Short point there, Edelweiss in its note has said that you're seeing some kind of reversal in the weakness in the European market, and also the bottlenecks in shipments to Russia.
Let's see if that plays out in the June quarter. Only then probably we'll see some analysts turning around. But at this point of time, the outlook on growth remains very sluggish, and there are better stocks out there with better growth opportunities to offer than Ipca Labs, is what I feel.
So it looks like bulls will end this week on a very happy note.
I hope this is not a repeat of Wednesday, Thursday, Tuesday and Monday, and instead is a repeat of Thursday, where we saw buying happening in the last 2 hours of trade, and we ended up higher. I hope that is the case.
Don't worry, CJ. I think bears are taking a break for now, so I think bulls can party for a while. There'll be some bit of short covering, and then it will be back to square one.
We can say bye to bears for the timing. Please take a vacation, guys. You have had a good amount of fun. Take a vacation for a few months.
Well, with that, it's a wrap. We'll let you get back to your trading. Thank you for watching this edition of Markets with Santo and CJ, and I hope you enjoyed watching it. Please do share your feedback as well.
And do follow us on the social media links at the bottom of your screen. And for rest of your updates, stay tuned to moneycontrol.com and the Moneycontrol app. We will catch you live at 3 p.m. with all the day's action. Thank you for watching.